Gold isn't forever, it would seem, at least when it comes to investing. Our next guest is here with some safe haven help. She's got the rest of our morning business covered as well. Ashleigh Patterson is a senior finance editor at Yahoo Canada. Ashleigh, great to see you.
Great to see you as well.
Gold was always considered for eons a safe haven, and then skyrocketed. Even a couple of years ago, it's coming down pretty fast and hard these days.
Definitely. We saw between Friday and Monday the biggest two-day drop for gold in 30 years. And over the course of the year, gold is actually down about 18%, which is odd because for the past 12 years, we've seen 12 consecutive years of rises. Gold, as you said, has traditionally been known as a safe haven for investor because it was seen as a hedge against inflation. And as to why gold plummeted, last Friday and Monday, it's up in the air, really. There's some speculation that it was because there was rumors that the Central Bank of Cyprus was going to be selling its gold reserves. There was speculation that it was ETFs trying to liquidate their positions, or maybe the strength in the US dollar, because the gold and the US dollar are inverse to one another. So really, analysts, traders, people in the commodity space are kind of puzzled still as to why gold has been, such a volatile commodity.
Well, the other
right
thing
now.
It could be is that the safe haven has become the U.S. dollar, and gold to an extent, sure, it's an inflation hedge, no question about that, but it's also a competing currency on the world stage.
Definitely, definitely. And I mean, in terms of investors where they should be putting their money now, it still remains to be seen. I mean, the best advice that I can give is make sure your portfolio is diversified as possible, both geographically and as well in terms of asset class. So, I mean, really anything above 5 to 10% is really where you want to cap it, and especially for something that's we've seen so volatile as gold.
Yeah. You talk about stocks and bonds. If interest rates start to move up, bonds are going to be in trouble to a degree. And I'm not sure about stocks, whether there'll be any kind of a safe haven as well. But people don't think about gold as a safe haven when it does pop up, or diamonds. They're often a safe haven, art, those kinds of things. So
yeah, those kind of alternative investments, as they're known, really. The art market is a great one. Again, it's not necessarily for the traditional everyday retail investor like myself or, the average Canadian, but it's definitely something to think about if you've got an extra little bit of money to play around with, for sure.
Deal. Speaking about money, Bank of Canada, did a couple of things. Kept its interest rates low and indicated they're going to stay low for some time, but also took their forecast for the Canadian economy down a little bit. What do you make of all that?
Well, it's interesting because, I mean, as you said, they kept their overnight key lending rate at 1%, which was expected. But then they chopped their forecast for 2013. It was originally supposed to be around 2%. That's what they predicted in January. But then they chopped it to 1.5, which really brings it in line with what the IMF is predicting for 2013. Basically, it's what we've seen a lot from the Bank of Canada. They predict so much growth, and then they have to kind of scale it back when they see actually how the economy is performing. And I mean, a lot of it has to do with a lack of business investment that they're predicting going forward, cuts in government spending, and also because our economy is so tied to the U.S., how the recovery is going to play out in the U.S. as well.
But they want to have their cake and eat it too, because they're keeping it at 1%, and yet they're still talking about a tightening bias per se, meaning that interest rates could move up at some point in the future.
Right. I mean, it all really depends on where inflation goes right now. And as we look ahead to Friday's inflation report, that will be another key signal for us. We've seen a lot of choppy reporting in terms of inflation lately. For January, it was probably, I can't remember now, I think it was, for February, it was the largest decline I think we've seen since, the largest rise since about 1991. And that was spiked up because of gas prices, where in January we saw a decline. And so it remains to be seen what we're going to see for March.
Your point is well made, because the mandate of the Bank of Canada is to keep inflation in control, whereas the mandate for the central bank in the United States, or even in Europe for that matter, is to address things like job growth and growth in the economy, as well as inflation. So they have a kind of a different mandate, don't they? They
do, and most central banks around the world do have those key little tweaks to their mandates. I don't think that there's going to be any pressure in terms of Canada, for example, maintaining that 2% inflation target. I think that going forward, we're not going to see a lot of pressure for the bank to raise rates, especially not until 2015, which is when really the Bank of Canada is predicting that our growth will actually be back on pace.
Well, it's interesting you bring that up, because it seems to me a lot of people have fallen asleep at the switch when it comes to inflation, because while we don't have any in Western society, recognize we have huge levels of debt. And in order to pay off all that debt, we have to get the economy going, and that's going to result in inflation. And in the economies that are moving ahead, we are seeing inflation. China, I mean, their wage inflation is running close to 100%.
Oh, definitely. And I mean, we're seeing a different story play out in emerging markets for sure. And I mean, if you look at Japan, they're actually struggling with deflation. Their central bank is actually trying to raise the level of inflation there.
Yeah.
So, I mean, the Canadian economy is not necessarily an outlier, but it's definitely, things play out in a different scope depending on, you know, where you're looking in the world, whether it be Western economies, emerging markets, or big Asian partners like China, Japan.
Yeah. Which points to the fact that you need that diversification. So when we talk about let's go back to that, gold as a safe haven, are there other safe havens internationally, maybe international stock markets people should also look at in their portfolios? That's part of the diversification argument.
Right. I mean, ultimately it comes down to how much risk that you're willing to take on, and where, I mean, if you have all of your ducks in one basket, let's say you put all of your money into Canadian financials, that's really not a very smart move. You know, you want to keep it on domestic soil, but like you said, it's really better to look outside of Canadian borders. Make sure that you're looking at all kinds of different asset classes, whether they be fixed income, stocks, commodities, and make sure that you have your money spread out across many different factors so that when we do see massive dips or spikes, you're kind of leveling out the playing field.
Good advice, Ashley. Great to have you on.
Great, thank you.
See you next week.
Yep, for sure.
Ashleigh Patterson is the Senior Finance Editor at Yahoo Canada.